Subscribe now and press the bell icon for latest information.
Hello friends, welcome to our channel. In this video we are going to discuss equity shares, merits or limitations of equity shares, preference shares, merits and limitations of preference shares, types of preference shares and difference between the equity shares and preference shares. Let's start. What is shares? Let us know first what is share. A share is a small unit in which the total capital of the company is divided. Share capital is the capital obtained by the issue of shares. Normally, two types of shares are issued by the company, that are equity shares or preference shares. The capital obtained by issue of equity shares is known as equity share capital. It is the most important source of obtaining the long-term finance by company. Equity shares are the owners of the company. Therefore, the funds raised by the issue of equity share is known as owners funds or ownership capital. The rate of dividend payable to equity shareholder is not fixed. They receive what is left over after meeting the all others claim. Therefore, the equity shareholders are known as the residual value. They have the right to vote, participate in the management of the company. They enjoy the reward as well as bear the risk of ownership. Let us discuss the merits of equity shares. Point number 1. Equity shares capital does not create any charge on the assets of the company. Point number 2. Voting rights of equity shareholders assure democratic control over the management of the company. Point number 3. Equity share capital is to be repaid only at the time of winding up of the company. Hence, it's the permanent capital of the business. Point number 4. There is no burden on the company in respect of dividend payable to equity shareholder because it is not compulsory to pay dividend to the equity shareholder. Point number 5. Equity shares are generally suitable for those investors who are willing to undertake the higher returns. Point number 6. Equity share capital increase creditworthiness of the company and also provide confidence to prospective loan providers. So these 6 points are the merits of equity shares. Limitations of equity shares. Point number 1. The voting power and earning of existing equity shareholder is affected by the issue of additional equity shares. Point number 2. Raising funds through issue of equity shares involves lot of formalities and lengthy procedures. Point number 3. Since the dividend payable to equity shareholders keep on fluctuating, investors who want to steady income do not prefer them. Point number 4. The cost of raising funds through equity shares is generally most com- compared to the other sources. So these 4 points are the limitations of equity shares. Preference shares. Preference shares. What are preference shares? The capital obtained by the issue of preference shares is known as the preference share capital. The preference shares holder enjoy the following two preferential position over equity shareholders. First position, the rate of dividend payable to them is fixed and is paid before any dividend is declared on for equity shareholders. Second position, at the time of liquidation of the company, their capital is written before any payment is made to equity shareholders, but after the claim of the company's creditors have been settled. Let us discuss the merits of preference shares. Preference shareholders do not have voting right. Thus, do not affect the control of the equity shareholders or the management of the company. Point number 2. They get steady income in the form of fixed rate of the return and safety of the investment from profitable business. Point number 3. Investors who want to fix rate of return with a comparatively low risk prefer to invest in preference shares. Point number 4. They do not create any charge on the assets of the company. Fifth, since the dividend payable to preference shareholders is fixed, therefore the company is in the position to declare high rate of dividend for the equity shareholders during the good times. Next, they have the preferential right to repayment of capital over equity shareholders at the time of winding up of the company. So these 6 points are the merits or advantages of preference shares. Let us discuss the limitations of preference shares. Generally, the rate of dividend payable on preference shares is higher than the rate of interest on debentures. Point number second, they claim equity shareholders or assets of the company is affected by the issue of preference share capital. Point number 3, investors willing to take risk and earn higher rate of return do not prefer preference shares. Point number 3, since the dividend paid is not deductible from the profit as expense, therefore there is no tax saving as in case of interest on the debenture or loans. Point number 5, there is no consistent return from the investors because the dividend is payable to the preference shareholders only when the company is earn profit. So these are the limitations of preference shares. Of types of preference shares. What are the different types of preference shares? The first type of preference shares is participating and non-participating preference shares. Participating preference shares are those shares which have the right to participate in the surplus of the company after a certain rate of dividend has been paid to equity shareholders. Preference shares which do not enjoy the right of the participation in the profit of the company are known as non-participating preference shares. The second type of preference shares are cumulative and non-cumulative preference shares. The preference shares whose dividend is paid during the year and get accumulative known as a cumulative preference shares, while the preference shares which do not enjoy the right as well as are as known as non-cumulative preference shares. The third type of preference shares is convertible and non-convertible preference shares. Convertible preference shares are those shares which can convert it into equity shares after a specified period of time, while the preference shares which cannot be converted into equity share are known as non-convertible preference shares. So these 3 points are the types of preference shares.
Subscribe now and press the bell icon for latest information.